Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know, first, Nvidia's $20 billion Groq acquisition signals a major consolidation play, acquiring rival LPU tech that's 10 times faster for AI inference. We'll analyze why this massive premium is a turning point for AI chip consolidation and how it could trigger intense antitrust scrutiny in the US and Europe. Second, the AI boom's immense heat is forcing data centers to adopt liquid cooling, creating a crisis with forever chemicals and obsolete infrastructure. Today, we'll take a closer look at this accuracy-sustainability trade-off and its implications for the future of AI development and data center design. Third free streamer, Tubi surpasses Peacock and Max, disrupting the streaming wars with a content arbitrage model that has captured the Gen Z audience. We'll explore how its low-cost library and ad model could transform streaming business strategies and the billion-dollar fight for younger viewers. Fourth, the US weaponizes visa sanctions against UK and EU anti-disinformation researchers, escalating a global clash over internet censorship and digital sovereignty. So we'll discuss why this diplomatic bombshell matters and what it means for the future of international tech regulation and free speech debates online. Fifth, Bitcoin opens a soft power dive bar and secret think tank in Washington D.C., attempting to rebrand its image for policymakers. In this episode, we'll break down this unconventional lobbying strategy and what it signals for how decentralized movements seek mainstream political influence. Nvidia just dropped a $20 billion bombshell, agreeing to buy the AI chip startup Groq in an all-cash deal. A while back, we talked about how a tiny number of companies control the high-end chips that form the choke points of modern AI. This move is Nvidia doubling down on that control. To put that number in perspective, this is by far Nvidia's largest acquisition ever, nearly tripling its previous $7 billion record. And the timing is an absolute shocker. Just 3 months ago, Groq raised money at a valuation of about $6.9 billion. Today, Nvidia is paying almost 3 times that amount. As we've discussed before, valuations in this space are already frothy. This one blows past even the top end. The reason this is so wild is that this new valuation represents a roughly 40 times multiple on Groq's projected annual revenue. For comparison, most hot AI startups are valued at 8 to 20 times their revenue. This isn't just a high price. It's a signal that Nvidia sees Groq's technology as either an existential threat or a game-changing asset, and they were willing to pay an unbelievable premium to take it off the board. And the story behind the deal is just as interesting. According to the lead investor in Groq's last funding round, the startup wasn't even pursuing a sale when Nvidia approached them. This deal came together, in his words, quickly. This all begs the question, what's the real endgame here? It turns out Groq's founder and CEO, Jonathan Ross, was one of the original creators of Google's Tensor Processing Unit, or TPU. That's the custom chip, seen as one of the few real alternatives to Nvidia's own graphics processing units that dominate the market. In essence, Nvidia isn't just buying a startup, it's acquiring the architect of a rival technology. Now, get this, Nvidia's GPUs are masters of parallel processing, which is fantastic for training massive AI models. But Groq's chip, the LPU or language processing unit, is a completely different beast. It's built for one thing, speed of inference. That's the process of actually running a model and getting an answer. The LPU is deterministic, meaning it processes tasks sequentially and predictably, which cuts down on latency. How much faster are we talking? Well, benchmarks show Groq's LPU can generate over 500 words in about 1 second. A top-tier Nvidia GPU might take nearly 10 seconds for that same task. So Nvidia isn't just buying a competitor, it's buying a fundamentally different and potentially superior approach to real-time AI. This move cashes out major investors from a recent funding round, including BlackRock, Samsung, and a firm where Donald Trump Jr. is a partner. A while back, we flagged the political cross-currents around Nvidia from Senator Warren's criticism of a proposed toll road export license approach to scrutiny, of Jensen Huang's proximity to Trump, and the DOJ's China-linked smuggling crackdown. So expect the optics around who benefits here to get attention. While Groq's cloud business isn't part of the transaction, the core chip assets are now under Nvidia's control. So What's the play here? Nvidia deliberately left Groq's cloud service, Groq Cloud, out of the deal. By not acquiring Groq's cloud service, Nvidia avoids directly competing with its own biggest customers like Amazon, Google, and Microsoft. Continuing our earlier coverage on export controls and approved customers in China, this keeps Nvidia positioned as the neutral arms dealer to the hyperscalers while it navigates those policy gatekeepers, and it pockets Groq's core tech without rocking its channel. With over $60 billion in cash and short-term investments, Nvidia has the firepower to make these moves. The company is sending a clear message to the entire industry. It's not just focused on building the future of AI, it's actively acquiring the competition to consolidate its power and cement its throne in the AI chip market. We previously warned that the AI build-out is creating trillion-dollar data center bets and supply choke points. Consolidation like this is Nvidia's way of securing the pipeline as AI adoption hits its tipping point. However, this is where the situation takes a more complex turn. With Nvidia already controlling an estimated 80 to 95% of the AI chip market, you can bet regulators in the US and Europe are going to be scrutinizing this deal very, very closely. We all remember Nvidia's failed $40 billion bid to buy the chip designer ARM, which was blocked due to fears it would stifle competition. Layer on the fact that Nvidia's access to China whipsawed under recent export controls, a market we noted had once been a massive revenue driver, and the antitrust and national security lenses are going to be even sharper. The question now is whether regulators will see this acquisition of a key high-performance competitor as another step toward a monopoly, potentially blocking the deal to keep innovation in the AI hardware space alive. Speaking of the immense power of these AI chips, all that processing generates an incredible amount of heat, which brings us to our next story. Let's start with a single image that might just change your perspective on the internet. To keep it from melting down, some of the world's most powerful computer chips are basically living at a spa. They're getting showers, sprays, and even relaxing in circulating baths of cooling fluid. This isn't a luxury, it's a necessity. The boom in artificial intelligence is pushing data centers to a breaking point. So the thing is, the chips powering AI perform trillions of calculations per second. This incredible density of computing power generates an intense, concentrated heat that traditional cooling methods were never designed to handle. We're talking about a level of heat that can literally melt the hardware if not managed perfectly. Traditional air cooling, basically using giant fans, can no longer handle the heat. This is a huge deal because the entire global infrastructure of data centers was built around air cooling. This shift to liquid cooling creates a massive problem. What happens to all those existing facilities? Experts are now worried about a future of stranded assets. These are billions of dollars worth of data centers that could become obsolete because retrofitting them for liquid cooling is incredibly expensive and complex. We're talking over $1 million just to retrofit one facility with no guarantee it will be efficient. The consequences of failure are huge. Just last November, a cooling system failure at a data center sent financial trading tech offline at CME Group, the world's largest exchange operator. Now, a new battle is raging over how to cool these digital brains. The answer might be liquid. Believe it or not, some of the most effective liquid coolants are what are known as PFAS, or forever chemicals. These substances are incredibly persistent in the environment and have been linked to health risks. With regulators in the US and Europe cracking down and a major manufacturer phasing out production, the industry is in a race to find safe, scalable alternatives. They're trading an energy problem for a potential chemical contamination crisis. One liquid cooling firm, Isotope, claims its approach can slash cooling-related energy demands by a staggering 80%. The CEO says their customers are now running servers at maximum speed, what's called overclocking, at all times with zero risk of burning out the server. One of their clients even plans to use the captured heat to warm a hotel swimming pool. And while that sounds like a perfect, sustainable solution, it's actually not that simple. Reusing waste heat is often called a heat reuse mirage. While there are amazing success stories, like a metadata center in Denmark that heats 11,000 homes, the logistical and economic barriers are huge. It often requires massive infrastructure and a nearby community that can actually use the low-grade heat, making it a niche solution, not a universal fix. In the race for a solution, some of the ideas have been pretty extreme. For instance, Microsoft famously sank an entire data center in a tube off the coast of Scotland, letting the cold seawater do the work. While the project was ultimately shut down over economics, the experiment proved that extreme ideas are on the table. This is where a new geopolitical competition is emerging. While Microsoft's underwater project is retired, China now has a fully times, operational times commercial underwater data center. It's powered almost entirely by offshore wind and uses the seawater for cooling, making it incredibly efficient. This isn't just an experiment, it's part of a national strategy, signaling that access to advanced cooling technology could become the next strategic battleground, just like computer chips. What really brought this to a head, though, was the next development in AI itself. According to one expert, the next generation of AI, called reasoning models, could use hundreds or thousands of times more energy than the chatbots we use today. This presents a fascinating duality for the industry. On one side, the push for more powerful AI, while on the other, it exposes a terrifying energy problem. Researchers have found that these advanced AIs, the ones that do multi-step problem solving, can use up to 50 times more energy times per query times than a simple chatbot. One study estimated that the next generation, GPT-5, could be 8 times more power hungry than GPT-4. This creates what experts call an accuracy sustainability trade-off, where the smartest and most capable AIs are also the most environmentally damaging. This all sets the stage for a bold counter-narrative claim from a key player in the cooling industry. The CEO of Isotope just went on the record stating that the large language models driving the AI boom have already reached their limit in terms of productivity. While the hardware side of tech grapples with those kinds of physical limits and soaring costs, a fascinating countertrend is happening in the world of content, where free is suddenly winning. The streaming wars just had a major upset. A free service, Tubi, has officially surpassed both Peacock and HBO Max in total streaming minutes, according to Nielsen. This isn't a fluke. It's a direct consequence of a rebellion happening in living rooms everywhere. As subscription giants like Netflix and Disney Plus hike prices and crack down on password sharing, viewers are flocking to free alternatives. Tubi's chief content officer, Adam Lewinson, put it bluntly, people used to cut the cord, now they're cancelling subscriptions. And is that driving more consumption into free streaming? Absolutely. While its rivals were spending billions on original content, Fox Corporation played a different game. It acquired Tubi in 2020 for just $440 million. That bet is now paying off massively. Tubi's strategy is actually something experts call content arbitrage. Instead of spending a fortune on brand new shows for comparison, Netflix's content budget is around $17 billion a year. Tubi licenses vast amounts of older, cheaper, and niche content. They build a massive library for a fraction of the cost and then make their money back from advertisers. It's a brilliant way to avoid the high-risk, high-reward game of producing originals. Fox's stock is up over 40% this year, while other media stocks have struggled. Tubi itself just hit profitability for the first time, with revenue soaring 27% last quarter. So what's the secret? Tubi cracked the code on the one audience everyone is fighting for, Gen Z. Nearly 60% of its viewers are millennials or Gen Z. The platform proved it could pull young viewers away from short-form video with original movies like Sidelined 2, which attracted a median new viewer age of just 21 years old. But it's not just movies. Tubi is also creating a new pipeline from social media to Hollywood. Through its Tubi for Creators initiative, it's bringing over content from massive digital stars like Mr. Beast. This gives creators a new way to reach a broader audience and gives Tubi a low-cost way to get content that Gen Z already loves. This isn't just passive background viewing. Tubi reports that 95% of its audience actively chooses what to watch, just like on Netflix. They're leaning in, which is a powerful sales pitch to advertisers. For advertisers, the data paints an even clearer picture. The average cost to reach 1,000 viewers, what we call CPM, is around $18 on Tubi. That's less than half of what advertisers pay on Netflix, which is closer to $37. Why? Because Tubi is delivering a unique audience. Research shows that 30% of its viewers aren't found on any other major free streaming platform. For an advertiser, that's pure untapped reach. With a massive library of over 300,000 titles, Tubi has become a giant slayer by offering an escape from subscription fatigue. So, you might be wondering, how does anyone find something to watch in a library that huge? Well, that's where their tech comes in. Tubi thrives on what's called the long tail, all of those obscure and niche titles. Their recommendation engine is specifically designed to surface hidden gems, unlike Netflix's, which tends to push its big budget originals. They're even using AI tools to give you personalized suggestions so you're not just endlessly scrolling. As paid services add more restrictions and higher costs, Tubi's rise proves a powerful new reality. The biggest threat isn't another paid competitor, but a free, ad-supported juggernaut that has successfully captured the next generation. From one kind of disruption in the media landscape to a much bigger one on the world stage, the United States government just sent a message that is an absolute bombshell. A State Department official declared, quote, "If you spend your career fomenting censorship of American speech, you're unwelcome on American soil." To put this in context, these kinds of visa sanctions are historically reserved for human rights abusers, corrupt officials, or people threatening national security. Using them against researchers and policymakers from allied nations over disagreements on tech policy, that's a massive shift in how diplomatic tools are used. This is a new front in international relations where diplomatic tools are being weaponized to enforce a specific view of how the internet should be governed. This wasn't just a warning. This was the announcement of visa-related sanctions against two British anti-disinformation campaigners, Imran Ahmed, who leads the Centre for Countering Digital Hate, or CCDH, and Claire Melford, the CEO of the Global Disinformation Index. Now, the US government frames these groups as fomenting censorship, but it's important to understand how they actually operate. Organisations like the CCDH and the Global Disinformation Index are non-governmental watchdogs. They publish research and create risk ratings for news sites with the stated goal of convincing advertisers to stop funding what they identify as hate speech or disinformation. They aim to cut off the money supply to bad actors. But that's not the whole picture. The real turning point is that both of these campaigners have clashed directly and publicly with tech entrepreneur Elon Musk. The CCDH has published reports on the rise of extremist content on X, prompting Musk to unsuccessfully sue the organisation and call it a criminal organisation. Musk has also called for the Global Disinformation Index to be shut down. Interestingly enough, the sanctions also target Thierry Breton, a former EU commissioner who helped spearhead Europe's massive Digital Services Act. That's the same act under which Musk's company X was hit with a staggering 120 million euros fine. This decision brings into focus a fundamental clash of philosophies. We're seeing the US approach rooted in the First Amendment and Section 230's hands-off model, while at the same time, Europe is taking a completely different path with its Digital Services Act. It's a battle between two completely different ideas of what a free and safe internet should look like, centered on digital sovereignty and platform accountability. Now, Europe is firing back. The French government, led by President Emmanuel Macron, called the US sanctions intimidation and coercion aimed at undermining European digital sovereignty. A spokesperson for the Global Disinformation Index labelled the move an authoritarian attack on free speech and an egregious act of government censorship. This is being called the first shot in a new global free speech war. And campaigners are now warning that with its own Online Safety Act, the UK is likely to be next in the firing line. The implications of this are huge. After all, this isn't just a diplomatic spat, it creates what experts call a chilling effect. The UK's regulator, Ofcom, is now in a tough spot. Do they fully enforce their own country's Online Safety Act and risk diplomatic conflict and sanctions from their biggest ally, or do they soften their approach? This action by the US could fundamentally change how independent countries regulate technology within their own borders. We were just talking about this global clash over internet freedom and control, and that brings us perfectly to our final story. Get this. Bitcoin, the currency of anarchists and libertarians, just invaded the heart of its biggest enemy, Washington D.C. But they didn't send lobbyists. They opened a dive bar, and it presents a fascinating paradox. Why would a decentralized digital native ideology like Bitcoin even need a centralized physical embassy in the heart of the government it philosophically opposes? Actually, this move reveals the limits of purely digital communities. Research shows that even online movements need physical spaces, like hacker spaces or community centers, to build real trust and legitimacy. You can't just exist on the internet to truly influence the real world. You need a real world presence. The bar, named Pubkey, landed on K Street, the capital's lobbying hub, and the reception was ice cold. A popular DC blog commenter wrote, "Raise your hand if you plan to never set foot in there." When the previous establishment, a popular hangout for Republican staffers, closed to make way for Pubkey, people were heard yelling, "Fuck Bitcoin," from the karaoke room. This is the core of crypto's DC problem. The industry has become so partisan that a recent attempt to open a bipartisan bar was mocked so intensely it closed within 75 days. Just to give you some background on that, the bar was called Political Patties, and its logo featured a mashup of the Democratic donkey and the Republican elephant. It was meant to be a symbol of unity, but in a hyper-partisan city, it was seen as tone-deaf and backfired immediately. This is important because it shows that a generic call for bipartisanship doesn't work anymore. Pubkey's bet is that a shared specific interest, even a controversial one like Bitcoin, can be a much stronger unifier than vague political neutrality. But Pubkey's strategy is a massive plot twist. The founder's stated mission is to soften that hostility using soft power. Now, soft power isn't just a buzzword here. It's a real documented playbook. This is a strategy where you influence policy not through direct pressure and backroom deals, but through cultural engagement, building relationships, and establishing credibility. We've seen Silicon Valley do this for years, funding think tanks and hosting cultural events to subtly shape public opinion and policy. It's about winning hearts and minds, not just legislative votes. The plan? Forget stuffy meetings and white papers. They're using affordable burgers, Mario Kart tournaments, and a secret chop house to win over the very staffers and policymakers who could write the laws to regulate them. If that was just the appetizer, the main course is just being served. This isn't just a bar. Hidden literally behind the beer taps, past the comfy couches and neon signs, is the entrance to a non-partisan think tank, the Bitcoin Policy Institute, a policy research center whose front door is a dive bar. What's remarkable is that they're essentially acting like a stateless nation. By using terms like Policy Institute and creating a physical embassy in a global capital, the Bitcoin community is mimicking the cultural diplomacy of actual countries. Think of Germany's Goethe Institute or China's Confucius Institutes. These are state-sponsored cultural centers designed to project influence. Bitcoin is doing it from the grassroots up, attempting to legitimize itself as a global player on the world stage. Their VIP preview was a spectacle designed for maximum effect. The US Treasury Secretary and multiple members of Congress mingled amidst mariachi bands, Chinese lion dancers, and a portrait of Pepe the Frog dressed as Napoleon. It's a deliberate culture clash, aiming to rebrand Bitcoin's image from shady dealings to quirky and approachable. When we place this new friendly image alongside the technology's radical origins in the cypherpunk movement, the contradiction becomes clear. This rebranding effort is strategically sanitizing Bitcoin's culture for political acceptance. And that's a risky move because for lawmakers to regulate a technology this powerful, they need to understand its full history and ideology, not just the fun, quirky, and approachable version served up with a burger. This is a new playbook for influence in one of the world's most powerful cities. As one DC power player noted, this is a new kind of coalition building, playing the long game for legitimacy. It's not like Pubkey is just trying to sell drinks.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.